Now I want to launch a short video of Alaska company, and while it will be here, maybe if somebody of you are tired and you want a short break, you can have it now. Also, as Tim told, there is another part of our event is an art gallery here, just on my left hand. You can also check it. And now please launch this video. Let's watch it. And if you need, have a short break.
It's no man's land. Cold and harsh. Full of cutthroats, robbers, and other scumbags. But with tremendous opportunities. Everything you find, you can keep.
Okay, as I told you, today we have not only pictures. You have seen already two interesting articles which people prepared and told you. And now we have another special guest. It is Mr. Feroz Sanaullah, and he will tell you about ventures, capital, basics. Please clap your hands. Let's invite him here.
Thank you so much. Thank you. Good evening, everyone. So I'm going to actually take you backwards in time. Instead of talking about Web3, I'm going to talk to you a little bit about venture capital, which is what I did for many years of my life. And I'll tell you the reason for that. A lot of you have raised your money through ICOs, IEOs, and other token offerings. A time will come when you'll need to part with equity in your company. So I'll talk to you a little bit about what does that mean, how do you kind of release equity in your company, how to get the best valuations, what do investors look at, and how do you govern yourself after that, right? Not everything is going to be a DAO, right? So just keep that in the back of your mind. Now, I am the oldest guy probably in this whole crowd. So I'm going to take you back a few years, and default you'll have to listen to me because this is kind of my story as I grew into venture capital and I invested in lots of companies. So I actually started Intel Capital here, and Intel, the computer company, was quite involved with startups through all their careers. We had about $10.8 billion we invested in startups. So when we talk a little bit about venture capital and how venture capitalists look at your companies, there's a dichotomy. A dichotomy is there's you on one side looking for money, and then there's the investor on the other side looking to invest. And of course, therein lies a problem because the investor wants the best deal possible. And of course, you as an entrepreneur wants the least dilution possible because that's what you really are trying to do, is to build a company where you can be very wealthy. And what happens is the people forget that that tension also has another factor. And that factor is the environment. How cheap is money? How much liquidity is in the market? Is there a macro environment problem which is coming your way where inflation is probably zooming ahead and interest rates might go up? And if they do go up, guess what? Money becomes expensive. And when money becomes expensive, you don't get the money, or you get it at a valuation that you don't want to tolerate. So what I tell people is that it is that balance you have to strike when you're trying to deal with VCs. And one of the big fatal mistakes that people do is they go and try and squeeze and squeeze and squeeze and get the largest amount of money for the lowest amount of dilution. That only leads you to a one-way street. And what I mean by that one-way street is that a time comes when if your fundamentals don't catch up and your delivery doesn't catch up with what you've promised, the next round of dilution is severe. In fact, many companies shut down because they can't swallow that valuation, and it's called a down round. And the biggest thing you need to avoid is a down round. You need to be able to make sure that you bring money in steps. So evaluation, money, evaluation, money, evaluation, money. And as you bring that, what happens is you continue to ride the wave, and the investor also continues to ride the wave along the way. And that's the best balance you can strike. And it's a very difficult balance, by the way. It's not an easy balance, right? So as an entrepreneur, when you're looking at raising money, think of those things very carefully, right? Dilute yourself to an adequate level, but not to a level where you don't let the investor make any money, because he or she will never be a good friend, right? Take them with you, because guess what? You're doing one deal with them. They do these deals every day, all the time. Think of it as worse than a marriage, right? Because a marriage, you can get a divorce. Try divorcing an investor. It's very difficult. You can't get away, right? So important thing is to make sure that when you are going to have a deal with an investor, you like who you're talking to. They can add the value that you need to be added to your company. They can open their networks and give you access to their large network and add value on a day-to-day basis, right? And those are the investors that are, kind of the matchmakers for you. Now, not every investor could do that, right? So when I was doing venture capital investing, a lot of times, if I saw a company that didn't fit my portfolio, I would call a friend of mine and say, hey, look, this will fit in your portfolio, go invest. And guess what? Many a times they were the best deals for them, probably not for me. And that is also a part of the network, right? So just because you went to an investor and they said no, doesn't mean anything. What you do to them is you say to them, hey, you're not the right person, who is? And they open many, many, many doors for you. So when you go out in the marketplace, yes, you can raise money in many shapes and forms. In the Web3 world, you do it through tokens and many other things. You create networks and communities. But at some point in time, you will need to be able to look at equity as well. And when you do look at equity, these are the questions that will come in. And the last part I'll leave with you is a much more boring part, which is ultimately it's about getting a term sheet. And a term sheet is when they lay out all the structured points of an investment into your company. And herein a friend of mine just earlier was talking to me and said, hey, why can't investors be long thinkers? Why can't they be like 7 or 10-year thinkers and invest in our company and build a network? Because you know what? Level 1 networks take a long time to build. And my answer to that is, even the largest VC in the world does not have their own money. They are an LP and a GP structure. So they are the GP, the general partners, but they also have limited partners in their partnership. And more those limited partners demand returns in a finite world. And the reason for that is very simply, it's very much driven by a return. It's called IRR. And a return is based on time, money in, and money out. Only 3 factors. And you can do a calculation very easily. So what ends up happening is when you take a long view, every year you add to that IRR, you're depressing the returns, right? And then the investor, who's an LP, thinks, hey, am I to put money in this venture fund and get a return of single digit, or am I to put it in a hedge fund where I could potentially get double digit? And guess what? The nature of investing is that the money will go where the highest returns are. And so it ends up happening that you are put in this environment where you have to demonstrate value month on month, year on year, so that you can show to the investor that the value of your company is going up, step by step. And if you think that there is going to be some sort of a grace period or a holiday for you to stay for 7-10 years before you can turn anything into reality, I think it's not going to happen. So saying that, I think somebody's prompting me to stop talking. I can continue to talk about it for a long time, but I'm here today. So just grab me if you want to know some fundamentals or basics about investing, particularly about venture capital, dilution, structuring. Happy to help you out. I've done this for many years, and one thing I learned very well, very early on, is help as many people as you can, all the time, every time, anytime. So please reach out to me. So thank you very much for your time.
Thank you. Here.